Live. It is 2 p.m. on Thursday, the 19th of November, and this is Sean. I'm going to be going through a lot of material today, so I want you to keep abreast of what we're talking about. For those of you who registered, thank you. We've got a ton of registries and a ton of people in the room right now. So go ahead and just let me know if you can hear me okay. This is the time when I want to make sure that all the audio is correct and that you can see my screen, things like that. So go ahead and just, in the text box, I want you to just chime in and just say, sounds good, or we can hear you, or whatever. That'll let me know that the audio is at least acceptable and you can hear me okay. All right. We've got more and more people joining us. For those of you who are joining us, just enter in the chat room and let me know that you can hear me okay. If not, then I'll assume that we have a problem with audio and we'll have to make an adjustment somehow, some way. Awesome. Perfect. Thank you, Kevin. Appreciate it. Okay, I'm going to get going real quickly. It's 2 o'clock, 2:01 now, and I want to respect your time. I'm going to try and keep this to about a half an hour or 45 minutes max. We're going to be going through several things today. We're going to be going over some articles of the week that I had sent out to everybody, and I hope you were able to download those articles and kind of take a look at them. I want to show you those articles from my perspective and what we look at, and then talk about how they affect your personal economy and how they affect the markets, the global markets in general, and the volatility of your wealth and your personal economy and your assets. All right. Then we're going to be diving into just another background or refresher of what does your personal economy even look like, okay? When money flows into your personal economy, how do you capture and control that? Where do you put it? And then we're going to transition into the second half of that conversation, which is, to me, it's the most important thing, and that is, how do we develop more income streams? And, what is the purpose for all long-term savings in general? Why don't we just spend all our money today and enjoy our lifestyle today? Why are we spending money or why are we saving money, for the future? What is it for? Okay. So we'll launch into that and we'll get a real clear picture on the future and what is expected of you in the future with your own personal economy. And I think you're going to be shocked when you see some of this stuff. So let me jump into some of these articles real quickly. I want to share my screen real quick with you. So I'm going to go ahead and do that now and then share this article. The first one I want to talk about is gold. Precious metals in general have been taking a beating as of late, as well as other commodity items. And those of you who are familiar with Mike Maloney and goldsilver.com, he has a brand new video out that I tell you what, on the follow-up email, I'm going to shoot you a link to his video. It's actually on YouTube, and he already has over 3 million hits or 3 million views on that video, and he just released it this week. So the first video that he did was on just how money works, and it's kind of eye-opening for a lot of people. It's your foundation or the basis for everything that we talk about with your personal economy. I like to call it your personal economy because I believe that people are getting sick and tired of talking about the national economy and the global economy. And what they really care about more is their family and what's happening in their own little world and in their own personal economy. So we do sell gold and silver and bullion. For those of you who are interested in repositioning some of your assets as a hedge into precious metals or some kind of commodity, unfortunately, commodities are on the edge of a steep cliff. And Maloney talks a lot about this. This is a natural consequence of the actions of our government and our Treasury and the Fed. It is nothing more than pure manipulation of the dollar-denominated value of those commodities. In other words, if you priced gold and silver in, if you priced gold and silver in oil and gas instead of US dollars, it will maintain its purchasing power. In other words, back in 1950, I tell this story a lot. Back in 1950, it used to cost about $2 to fill up your car with gas. And there were huge gas tanks back then in those huge gas guzzling cars, right? Well, it used to cost us $2 to fill up the entire tank of gas. The difference between the 50s and today is that back in the 50s, we were still on the gold standard and we used silver dollars. Or if we used paper dollars, they were actually called silver certificates. In other words, you could go into any bank in the nation and change or exchange your silver certificates, your paper currency, for the real stuff, for the silver dollars or for gold if you wanted to. Make sense? Well, because we were using silver dollars back then to buy gas, 2 silver dollars would fill up a tank of gas, right? Well, the price of real physical silver today is different than what the spot price is. The spot price is the price of the melt value of 1 ounce of silver, for example. If you were to melt down a silver coin and it's 1 ounce in size, that is what the spot price dictates or denotes. So if you're looking up spot prices of metals right now, you'll notice that silver has dropped below $15 an ounce. It's now close to $14 an ounce. It's $2 cheaper today in US dollars than it was a month ago. But has the value of silver changed at all? If you think about it, a couple of months ago when the US mints were out of silver dollars, they were out of silver eagles. We had a number of clients that had ordered silver and we had to fulfill those orders and we couldn't get them from the mint, so had to go shopping. I went to a couple of coin dealers and the spot price that day was right at about $15 an ounce for a 1 ounce silver coin. Okay. The cheapest I could find it at a coin dealership was $27 per coin. So $15 spot price, $27 real price of the physical silver. Where's the disconnect there? What's going on? That's what we're really keyed in on and focused on. So what we believe is that because of the devaluation of our currencies around the world, not just the US dollar, but the Chinese yuan, the Japanese yen, the euro, all of the major currencies around the world are printing like crazy, trying to devalue their currency so that it's cheaper to export their goods and services than it is to buy them from America. So it's a race to the bottom. So what does that mean for them? Well, it dilutes the purchasing power of their currency. So where do you think they're going to hold their wealth? Where do you think these central bankers from around the world actually position their wealth right now? Well, it's in US dollars, in the form of US treasuries. All dollars, paper dollars, are backed by the full faith and credit of the United States government, which really just means that it's backed by a treasury that the US Treasury Department has initiated. And those are typically 10-year treasuries, okay? So money is flooding into the 10-year treasury, which is driving up the price of the treasury and actually lowering the cost or the US dollar denominated value of gold and silver, as well as other commodities. So you can see here in this article, it's not just gold or metals, all commodities look ugly, okay? And if you look at the price failure of gold right now, you can see how it's drastically going down in US dollar denominated terms, okay? However, the same thing is happening with oil and gas. And so today, if you were to use silver dollars to purchase fuel for your car, and you had to buy those silver dollars from a coin dealership instead of a piece of paper on the stock exchange or on the COMEX, the Chicago Mercantile Exchange, you would pay $27 to $30 per coin, okay? So stay with me here. $2, 2 silver dollars, is equivalent to roughly $60, anywhere from from $50 to $60 in US dollars. All right. How much does it cost to fill up your car with gas today? You know, the price of gas has gone down. And so it's really closer to $50 than it was $60. And so technically, the cost or the value of that commodity, fuel, has not changed at all when you compare it to another commodity, silver. Does that make sense? What's happening is it's taking fewer dollars, paper dollars, to fill up your car with gas because the strength of the dollar is increasing because so many central bankers are flooding and moving their money into America and purchasing treasuries, US treasuries. And so that affects the value of our currency. And so whether or not you're holding physical assets, gold and silver or other commodities or US dollars, it really doesn't matter. It's literally when the time comes, you know, like Maloney says, we believe that we're going to see this trend continue throughout the beginning of next year, where we're going to see deflation. Deflation is simply the drop in price of commodity items, things we use every day, like food and fuel, oil and gas, you know, the stuff that we have to buy every day. So the price of those items will be going down, which will give us this feeling of being more wealthy. Our dollars will stretch farther and farther in the near future for a certain time until the Fed just can't hold on to the reins anymore. And when that breaks, when the Federal Reserve loses control over the printing of money and the cost of those commodities, that's when we'll see hyperinflation, and those commodity items will skyrocket in price. Okay. And what it'll look like literally is one day you'll own a bunch of silver and gold and it'll be going down in US dollars, in US dollar denominated terms, and you'll feel like you're losing money. And then the next day you'll wake up and all of a sudden you'll be a millionaire. Make sense? You'll be able to exchange those silver coins and those gold coins for whatever you want, whether it's food or fuel to survive, or you can put them into investments like land or property or real estate that's producing income. Make sense? All right, let's go on to the next article that I wanted to show you here. This is an interesting one. Title reads, Student Loan Debt, Get Ready for Robocalls. Now, our government is built on the premise that the laws are supposed to protect citizens, okay? One of the laws that protects citizens is when you get harassed over the phone by creditors, okay? There is an actual law that prohibits creditors from harassing you on the phone. It's a protection. It's a law that protects citizens, okay? The problem is that these government-backed student loans are over $1.3 trillion in size now, and the government needs to start collecting on that money. And so what are they doing? They're turning to the exact law that they enacted that is buried in a 56-page budget bill, and they've created a new rule in that bill that allows debt collectors to use robocalls on their cell phones if they owe student debt to the government. All right. Now, one of these students has already tried to sue one of these robocalling companies, and they lost the lawsuit. The provision makes the federal debt collectors exempt from any federal law that protects consumers from robocalls. Think about that. And where is that law being enacted? It's buried in a 56-page budget bill. Think about our current state of government and how ridiculous this is. They've taken a 56-page bill that's supposed to enact certain restrictions on our budget, and they've added a clause in there which gives the government the right to harass you over the phone. Our government at work, taxpayer dollars at work. You got to love it. All right. Third article that I wanted to go through, and this is important. This is important to what we're going to be talking about here in a second. Chicago and Houston face pension crises in the latest example of local government and fiscal folly or failure. Okay. So right now, I don't know if you remember the collapse of the Detroit economy. I think it was 2 summers ago, Detroit, they actually, most cities, municipalities, they borrow money for operations to operate the city. They borrow that money through bonds that you buy. So you're sold municipal bonds for a guaranteed rate of return or income at retirement because it's supposedly safe. The challenge is that these cities aren't being managed appropriately financially. They don't manage their own personal economy or the city economy effectively. And as such, they're imploding. And so they're unable to pay you your income on those bonds. That's the bottom line. So Detroit pension funds are totally bankrupt. They have no more money to pay those pension holders their income at retirement. The same is going to be happening with Houston and Chicago. And so my response to this article is, watch out. This is going to be sweeping the nation. Every municipal bond that you hold in your portfolio will begin to start failing. And what does that look like to you? It means loss of income, loss of wealth. Okay. This is a survey of costs by a company that I work with called Genworth Financial. We work with over 50 different life insurance companies and financial institutions. And so what I found really interesting is the cost of care in the state of Texas has just been skyrocketing. And so they broke it down by the United States versus all of Texas and then by city in Texas. And what's staggering to me is that if you have a long-term care need, in other words, you are disabled or something happens in your job or you just can't work anymore and you have to take disability, you're going to need to spend about $42,000 a year in Texas to be able to just maintain your home if you're unable to do so. Think about that. $42,000 of your income is going to have to be going out or transferring out of your personal economy in the form of expenses just to maintain your home. All right. When you talk about health aid services and hourly rates, we're talking about $42,000 in health aid services. So if you require a maid service or housekeeping and health care, you're up to, what is that, $80-something thousand, $84,000 right now. How much money do you expect to make in retirement when you begin to enter that phase of an aging population and are not working anymore and are drawing down on your Social Security, if it's still there, and your nest egg, your savings that you've spent your whole life working and saving for? How much of that wealth is going to have to go towards healthcare and just housing expenses? Well, if you're in an adult day healthcare, it's no different. You're going to be spending about $10,000 a year just to stay in a facility, an assisted living facility. Assisted living facilities for single occupancies, 1 bedroom, single occupancy. If you want your own bedroom, you're going to be spending an additional $42,000 if you're in the state of Texas. All right. And then nursing homes, which include, this is just for a semi-private room, but it includes 24-hour doctor and nurse care, okay, is $51,000. So think about this in terms of long-term care and the needs that you will have when you reach age 85, 90, 95, and 100 years old, and you require that health care. All right. What is that going to do to your personal economy? Okay. All right. So those are the articles. What I thought I'd jump into next phase is just a real brief overview of your personal economy. And so the reserve capital strategy is what we like to call it. And that's a trademark name that I came up with based on this concept of reserving capital and storing your cash inside of an insurance policy or inside of an insurance contract. The reason we love insurance is the number one reason is for safety of principle. Because this is a contract between you and the life insurance company, it has nothing to do with the banking system. And therefore, it's run completely differently than our banking system. And the main purpose, the main mission and purpose of creating your own personal economy, sorry there, forgive me, let me go back there. The main purpose of creating your own personal economy is so that you can improve your financial position by avoiding or minimizing unnecessary wealth transfers. What is a wealth transfer? What are wealth transfers? Well, a wealth transfer is any time that you spend your money for anything, whether it's taxes, whether it's interest expense on your home mortgage or your credit card debt, your car loan debt, student loan debt, your boat home, or your RV, your boat, whatever the case may be. When you're writing those checks every month, that is a transfer of your wealth. And the reason we call it a transfer is because that money is gone and lost forever. You can never recapture it, and you can never earn interest on those dollars that you transfer. And so what we do is we try to avoid those or minimize those unnecessary wealth transfers where possible, and accumulate an ever-increasing pool of cash that provides you accessibility, control, and uninterrupted compounding. And we'll show you what that looks like. But the fundamental key to the whole reserve capital strategy is that the money has to be accessible. You have to have access to your cash. It must be liquid whenever you need it or want it. The way that we access our cash is through collateralization or policy loans, okay? And so what does your personal economy look like? Again, let me just run through this real quickly as a refresher. This over here on the left-hand side is your income tank, and we earn income in various ways. We earn income through ordinary income, through our job. We also earn income or build wealth or have money flowing through our personal economy when we liquidate an asset or an investment. You know, if you have a monster box of silver and you sell that monster box of silver, that's wealth that you're generating in US dollars that's coming into your income tank. That money that comes into your income tank, we call that your entire lifetime capital potential, because it's finite. That number doesn't continue to go on forever, indefinitely. It stops when you stop working or stop making money, right? So the way that we handle every dollar that comes into our personal economy is critical. The typical way, there are two main ways that we transfer our wealth. As the money flows into your personal economy, typically it flows in monthly or bi-monthly through your ordinary income or other dividends that could be paid on a quarterly basis from an investment, for example. The first thing that we typically do, that we're taught to do, is to pay tax on that money, right? Well, that's a huge wealth transfer. The wealthiest families don't pay tax up front. What they do is they wait, have a team of accountants work as hard as they can to lower that tax liability, and they pay their taxes at the end of the year once that liability has been shrunk down and decreased as much as possible, okay? So the first change that we need to make and understand and realize is that if we want to be wealthy, if we want to have the resources available to us down the road, we need to do what the wealthy families do and stop doing what the Dave Ramseys and Susie Ormans are telling us to do, which is pay off all your debt today, spend your money today so that you can eventually get to a point where you're debt free, and then you get to start to save your money. That's backwards mentality. That's, you know, it might have worked back in the 80s or 30 years ago, but in today's economy, it's just simply wrong. And I'm speaking, you know, about a guy that I really admire. Dave Ramsey's a great guy and is a friend of mine. I know him personally, and yet he's just flat out wrong when it comes to his methodology. okay? The second way that we transfer our wealth is through our current lifestyle expenses, all right? Now, those could be anything. Those lifestyle expenses could be anything. It could be paying for cars, paying for homes, college education, entertainment expenses, living expenses, food, travel expenses, whatever the case may be. Once you spend all that money, it's gone forever, right? And so what we recommend is that you simply take that money, wherever that money is coming from. I don't care if you win the lottery or if it's coming from cash flow or if it's coming from liquidating an asset. We just recommend that you take a little bit of energy and effort, lock this tax valve down. Don't pay taxes up front if you can avoid it. You know, some people are in a W-2 situation and they have to have taxes withheld. My recommendation is to lower those withholdings as much as possible so you can capture and control more of your money, okay? And then the first thing you want to do is set up an emergency fund. Now, what does that look like? To me, that looks like a checking or savings account where you have a little bit of cash saved in there for immediate same-day emergencies. You know, if the car breaks down, if the water heater breaks, if you have something where you require to write a check really quickly, you need to build up a little bit of money in checking and savings. But how much do you build up in checking and savings? I don't carry more than $15,000 in our checking and savings account. The rest of my emergency fund is positioned into other savings vehicles like gold and silver, where it will hold its value and actually increase in value in US dollars down the road. All right, it's still part of my emergency fund. I just know that if I get injured and I break my leg and for some reason the insurance company isn't going to pay the bill, I can always liquidate that gold and silver and use that money to pay the bill. Make sense? All right. Well, the rest of your money, we store it in permanent life insurance. That's where we recommend you save your long-term savings, the rest of your wealth. So keep a little bit in checking and savings, and then make sure that you're paying all of your bills, all of your non-preferred debt, which is any debt that is non-tax deductible. Pump as much money as you can into life insurance and grow this account as quickly as possible. Now, why do we do that? Well, first of all, it controls and captures more of your wealth. How much wealth does it control and capture? Well, let's take a look. Let's look at your lifetime capital potential, all right? Now, this is an actual client of mine. He's 50 years old today, and we ran just a projection for 10 years. You know, he's planning on keeping his business for the next 10 years and then selling it. That's his exit strategy. He pays himself right around $100,000. I think it might be a little more like $120,000 a year in personal income out of the business, okay? And if that income were to grow or stay ahead of inflation, inflation is pegged at 3% right now, even though you and I both know that it's a lot higher than that. We're going to use 3% inflation growth, and he has a total net worth of about $650,000 right now. Most of that is tied up in his business that he owns, but some of that is in other qualified and non-qualified accounts, IRAs, 401ks, Roths, things like that. Now, if that money was to grow at 6%, which is what the dividend rate is for the loan, for the insurance accounts that we're paying right now, that's where we got that money. He's got his money invested in his business and other things that are paying much higher than 6%. He's getting way above average returns right now. But the point is, what would it look like if all things being equal, if everything grew at 6%? Now, check this out. This is staggering to me. By the time he reaches age 60, okay, in just 10 short years, between age 50 and 60, $1 million, $1.1 million of income will flow through his personal economy. So the first question I have for you is, how are you going to capture and control that $1.1 million and not transfer that wealth out of your personal economy, but let it earn uninterrupted compound growth? All right. Now, when you add in his total wealth, his total net worth growing at 6%, the number is just staggering over the next 10 years. over the next 10 years, his nest egg will have grown to $2.7 million. So again, I ask, how do you capture and control that money and not let it transfer? Because this is what we typically do. You know, what we typically do is we take taxes right off the top and we pay Uncle Sam, right? Well, if we were to pay Uncle Sam first in that scenario where you're making $100,000 a year and you have $650,000 in total net worth growing at 6%, okay? If you pay Uncle Sam first, look at how much of your wealth you're transferring just over the next 10 years. $473,000 will be transferred out of your personal economy and gone and lost forever, never to return and never to be able to earn interest on in the future, okay? But it doesn't stop there. The next thing we do is we pay debt service. Now, we all have mortgages or we have car loans, student loans, credit card debt. Every single one of us has some form or fashion of debt expense, okay? If you were to walk into a mortgage broker's office today and apply for a new mortgage, what they would do is they would add up all of your monthly expenses and compare that to your monthly income, and including your new monthly payment on the new mortgage that you're about to get, the maximum debt to income ratio or expenses to income ratio is 35%. So only 35% of your gross income can be going out of your personal economy in the form of debt service. Let's take a look at what that looks like over just the next 10 years. This makes me sick to my stomach. Over the next 10 years, you'll notice this client's going to transfer over $1 million of their own money just through taxes and debt service alone. And again, that's not only lost dollars, lost wealth, but that's also an opportunity cost. There's a cost to that. It's the lost interest that you could have made on that money over the next 10 years. Does that make sense? Everybody following me so far? Okay, I'm going to check in real quickly. Stop sharing my screen for a second here and check the... Okay, no questions so far. All right. If you have any questions, feel free to just write them in the chat box as they come up. I'm going to be jumping back and forth into the chat box so that I can answer those questions ongoing. Does anybody have any questions so far about your personal economy and what that looks like? Nobody yet? Okay, great. I'm going to keep going. All right. Let's see. All right, back to our personal economic model here. We don't stop there though. You know, our lifestyle is very expensive. We spend most of our wealth, our income, our cash flow on lifestyle expenses. And again, that includes anything from car payments, house payments, food, fuel, entertainment costs, college education, insurance expenses for medical insurance, whatever the case may be. It's your total family's overhead. All right. Now that number ranges anywhere from 20 to 40% in our country, in America. So I'm going to hit it right in the middle and just call it 30%. 30% of your gross income leaves your personal economy and is transferred and gone forever through ordinary lifestyle expenses. All right. First thing I want you to notice here, that gives you very little money to begin to start saving. So right away, you can see the Dave Ramsey approach of paying taxes first, paying off all your debt, and then making sure that you have enough money for your lifestyle and then starting to save. That's a plain, flat out wrong approach to building wealth. That is not what the wealthiest families do. In fact, that's not even what Dave Ramsey does himself, to be honest with you. Okay. But again, look at the staggering number here. We're talking about $1.5 million of your hard-earned wealth transferred and gone forever just through taxes, debt service, and lifestyle expenses alone. Okay. That's the cost of not employing this reserve capital strategy. Okay. So how do we fix that problem? Well, it's very simple. We make decisions on how much money we're going to save and where we're going to put it. Those are the two top concerns that most people have right now. How much of my income do I start to save, and where do I put it? When I get the sale of an asset, where do I put that money, that capital? Do I just simply reinvest it? Do I pay taxes on it first? Do I pay off all the debt that I have first? Or is there a more efficient way of allocating those resources? We say there is. So what we recommend people do is lock down this tax valve. Don't pay taxes up front. Take a little bit of energy and effort. Pump that money up into your life insurance account as much as you possibly can. Grow that inside the account because it's guaranteed. Your principal balance is guaranteed. Every dime that you add to the account is 100% guaranteed, never to be lost. And what's even better is that you actually get to collateralize this account whenever you want to, if you need the money or if you want the money. So for example, when you liquidate that real estate property that you've been holding on to forever, and you have capital gains tax on that real estate property, the first thing you're going to do is capture all of the gains, capture your returns on that property, stuff them all into your life insurance account as much as you possibly can. And then when you have to pay capital gains tax, you simply collateralize what you need to pay the tax bill and use the insurance company's money to pay Uncle Sam. Okay. Now, this is a loan. Loans are not considered ordinary, passive, or portfolio income, and therefore they're non-taxable. It's not considered income. So when you borrow against the policy, what you're essentially doing is using tax-free money to pay a tax bill to Uncle Sam. Think about that for a second. I'll say it again. You're using tax-free dollars to pay Uncle Sam the tax bill on your asset that you just sold. What does that do to you economically? It allows you to grow your savings and have more money, an ever increasing pool of cash to dip into if you want it or if you need it. Let's say you need to borrow more money. You have to borrow more money. Why? Well, you have to pay the bills, right? Or maybe you have to pay income tax or whatever the case may be. You can even borrow out as much as you want to and maximize that loan against your policy. Take all of that money, the life insurance company's money, and invest it in your next big investment, whether it's real estate, oil and gas, whatever the case may be. Now, we recommend income producing or dividend paying assets right now, rather than stocks that just have a simple nominal increase in price or gain. The reason we recommend income producing investments and not stocks is because the increase in stock price is artificially inflated by the Fed pumping money into the system. Does that make sense? When the Fed says that you can borrow money at 0% interest rates, what do you think corporations like Apple Computer and IBM are doing right now? They're borrowing as much money as they possibly can and acquiring companies at near 0% interest. Well, when they acquire that company, they simply add those earnings to their balance sheet, which gives the appearance that their PE ratio is in really good shape. The problem is that the earnings statement is wrong. It's just flat out wrong. It's a lie. And so how much do you trust the stock market right now? Especially with all the high frequency trading platforms that are just trying to trade back and forth and get nominal gains and then sell, take profits, and then do the whole thing all over. Or worse, drive the market down, buy it when it's cheap and let it ride up before they sell it again. You know, you and I are not going to be able to beat that system. So my recommendation, get out of the stock market. If you have a 401k or an IRA or a mutual fund or a qualified account in the market, we have an exit strategy for you and we can help you there. Just get in touch with me. Okay. Anyway, so this is the system. This is your personal economy on steroids, essentially. This is how you capture and control more of your wealth on an ongoing basis. Okay? Now, why do we do this? What's it for? Well, let's move over into this. What I wanted to show you was this slide presentation real quickly. Let me get it loaded up here. And I'm going to have to share my screen real quick. Let me share my screen. Looks like it's already shared. Sorry. Okay, so here's the key question. What is the underlying premise, or what is the mission and purpose for all long-term savings that anybody does? In other words, why are you giving up current enjoyment of your money, your wealth, your income today for the future? Why wouldn't you just, eat, drink, and be merry, for tomorrow we die kind of thing? Why do we save money? Well, it's so that we can have income streams at retirement. That's the bottom line. So if that's the ultimate mission and purpose of the agenda or the goal, then it only makes sense to understand how retirement income streams work so that you can direct those savings into the right places. Okay. So again, the two questions were, how much should you save and where should you put it? So in other words, how retirement income streams work economically defines how much money you're going to save and where you're going to allocate those savings today. And so the sooner you get on an efficient path, the greater the impact you're going to have down the road. And I'll show you that right now. Okay. So it's kind of like climbing a mountain. We use this analogy a lot. When you're saving for retirement, that's the climb up the mountain. We call that the accumulation phase. And so what is the objective of accumulating a giant nest egg? Is it really just to climb up the top of the mountain and then sit there and take a selfie? Is that the objective? No, it's not. It's to be able to build up a nest egg big enough so that when you start to spend that money down or climb back down the other side of the mountain, you can do so safely and without running out of money. Make sense? Now, I had a colleague tell me recently that people who climb Mount Everest, 75% of all deaths on Mount Everest are on the way back down the mountain, not on the way up the mountain. I'll say that again. 75% of the deaths on Mount Everest happen on the way back down the mountain, not on the way up the mountain. Why do you think that is? Why would that be? Why would more people die on the way down than on the climb up? Well, it's very simple. We know that things change in life. Conditions change when you're climbing a mountain. And 75% of people die on the way down just for one simple reason, because they didn't pack the right equipment on the way up for the climb down. If conditions change, if you get into a snowstorm or a really bad position where you're stuck on the mountain for any extended period of time and you didn't bring enough supplies, that's a huge danger of you dying halfway down the mountain. Think about that in terms of your retirement savings. All right. So there are two rates that are important for us to focus on that make up your retirement income strategy. The first is your accumulation rate, or your rate of return on your assets as you're accumulating or going up the mountain. The second rate is your distribution rate, or your spend down rate. We call that your spend down rate. All right. Both of these are equally important. Both rates are equally important. And so think about it this way. If you were going to climb a mountain, wouldn't you want to bring a guide with you? It would just make sense. You bring a Sherpa when you climb Mount Everest for one reason, because they know the best way up there, the safest way up the mountain. But what if you were talking to that guide and they said, you know what, I'm pretty sure I can get you up the mountain, but I'm only about 10% sure I can get you back down the mountain safely. Wouldn't you want to switch guides? Wouldn't you want to pick a different Sherpa? Well, that's literally where we are in the world today. We have this buy term, invest the difference mentality that's been drilled into us for the past 30 years by the likes of Susie Orman and Dave Ramsey, we're told to pay off our mortgage first so that we can get rid of all debt, and then we can start saving to build up our nest egg for retirement. But who's focusing on the distribution phase? Who's focusing on the income plan? Nobody. All right. Let me tell you a real quick story. When Social Security first came around back in the late 40s, early 50s, it was a safety net for people who were going to retire. In other words, the government said, you know what? You give us 40 hours a week of your hard labor, and we will guarantee that you will have income at retirement. And they called that program Social Security. Well, over the years, everybody quickly realized that people were living longer lives. You know, when they first implemented Social Security, the average life expectancy was 70 years old. And so if you were to retire at age 62, how much did the government really have to pay out in Social Security at that time? You know, it wasn't a lot. But as people started living longer, healthier lives, the government realized that that program wasn't solvent. It wasn't going to be able to continue to go. And so they pushed that responsibility on the shoulders of corporations, and corporations started developing pension funds, pension programs. They worked very similar to the Social Security program. If you worked hard and gave them 40 hours a week, they would take a portion of your income or your salary, put it into a pension fund, and they would guarantee a good percentage of your salary for the rest of your life in retirement. That's how pension programs work. Guaranteed income for life. Okay. Well, in the 80s, they realized that pension funds were not being managed effectively and the money was running out. Again, we had a different demographic change. People were living longer, healthier lives, and those pension funds were not big enough to be able to pay out that substantial percentage of your salary that you were expecting and still be solvent. So in the 80s, the government created an individual form of saving for retirement called a 401k. And all a 401k is it's actually a section in the tax code. It's section 401, paragraph K, and it simply states that if you save your money through this program, that you can save that money pre-taxed and that it'll grow tax deferred until you want to start using it as income. All right, makes sense? The challenge is what are taxes going to look like when you start drawing down on that 401k? Are they going to go up, down, or stay the same? And how is that going to affect your income at retirement? Okay, well, the current challenge that most economists are realizing now is that because of the 401k program and because of volatility in the marketplace, the safest withdrawal rate on your nest egg is only between 3 and 4% a year. So think about this. You build up this substantial nest egg and you can only spend it down at a rate of 3 to 4% a year safely so you don't run out of money in retirement. Make sense? Well, on $1 million retirement, if you're taking it out or spending it down at 3 to 4%, that's only $30,000 to $40,000 a year. Who here can live on $30,000 to $40,000 a year right now? Especially if you're accustomed to earning $100,000 today. If you're accustomed to earning $100,000 today, then that $1 million nest egg, you're withdrawing that at 10% a year. You follow me? Does everybody understand that? On $1 million nest egg, $100,000 a year is 10% a year spend down rate. Well, what about inflation? And what about taxes? In the future, if inflation just stays at 3%, 20 years from now, that $100,000 salary that you're accustomed to getting better be $180,000 a year just to maintain the purchasing power of your dollars. And so if you do the calculation and you reverse engineer that program or that savings plan, if you're needing $180,000 a year in retirement 20 years from now, that means you're going to have to accumulate a $5 million nest egg. Now, how many of you have saved $5 million? How many of you are ready for retirement? My guess is not very many of you, okay? And so what is the solution? Well, let's take a look, all right? This is a calculator that we use all the time with our clients. And what it does is it basically shows you your current plan for income streams at retirement versus changing that program and doing what we can do for you, okay? So we've got this client, Lotsa and Natsa Cash. Lotsa Cash is 45 years old. He's going to be retiring at 65. So it gives us a 20-year time horizon, just like the last graphic that we saw, okay? Now, he's done very well for himself. He's saved up about $200,000 in a 401k and about $300,000 in cash, okay? Now, what we're assuming here is that he's in the 30% tax bracket and that his wealth will grow at an average rate of return of 6%. But you know about statistics and averages, right? You guys have all heard the joke about the three statisticians that went bow hunting. Have you heard that one before? I'll tell it real quick. There were three statisticians that went bow hunting in Texas, and the first one shot 10 feet to the, they saw a deer that they wanted to get. The first one shot 10 feet to the left. The second statistician shot 10 feet from the right to the right. The third one jumped up and said, hey, we got him. So average rates of return are not real rates of return. We know that, right? But having said that, that is the actual dividend that these insurance programs are paying right now. So I'm using that number. And then the distribution rate or the spend down rate that we're going to use is 3.5%. We're going to hit it right in the middle between that 3 and 4% number. Make sense? So if they've saved up 200 grand in their 401k and it grows at 6%, at retirement, it'll have grown to $641,000. If they spend it down at 3.5%, as recommended by most economists, that only produces $22,000 a year from their 401k. Now, if their cash in their money market account was able to grow at 6% a year, which it's not, right? It's not, that'll never happen. It will have grown to almost $1 million, right? But since that's not happening, we need to adjust this number, all right, to make it more realistic. And so I was playing around with the numbers, and if I just reduce it by $16,500 a year, that savings, meaning it's not really growing at 6%. We know that's a fake number. It's just what the calculator throws out there. It's really probably closer to 1% growth rate. So that $300,000 over 20 years will have grown to $318,000 if it's in savings or in a money market. You follow me? Does that make sense to everybody? And so that will spin off at 3.5% spend down rate, about $11,000. So the bottom line is all of your savings combined, these guys are doing really good. They've got $500,000 saved up so far, and they're only 45 years old. And yet at retirement, they're only going to be able to spend down about $33,000 a year. Okay. Now this guy's pretty aggressive. So he's adding to that 401k to the tune of $17,500 a year. And he gets an employer match of about $10,000 a year. And so again, growing at 6% a year, that grows to over $1.7 million, which is much, much better. But if he has to stick to that 3.5% spend down rate, that doesn't leave him a lot more money to deal with. It's just a little bit more than the $33,000 that he had originally. So he'll be able to spend down about $48,000 a year if he continues to add to the 401k like he's doing right now. Make sense? Okay. Now, what we're analyzing here is what would it look like if we took this cash that's in a money market account and simply reposition that money into a life insurance policy over the next 10 years. And so what I've got here is bleeding out this money market account or this cash account to the tune of $30,000 a year for the next 10 years, okay? And putting that money into life insurance. I've got his life insurance policy, his illustration right here. You can see his name, lots of cash. Current age is 45. Okay. He's putting in $30,000 a year into a contract for the next 10 years. Actually, it shows 11 years, but that's just the illustration software. So we know it to be 10 years, right? Okay. So the initial cash value day one that he has access to is almost 20,000 of that 30,000. So if he needs to dip into that cash, he has liquidity immediately. Make sense? And so as he drains that down and puts 30,000 into life insurance, initially he's got 20,000 in cash value, and death benefit is close to 700,000 on day one. So I've just put those numbers here. Death benefit of 700,000. Sorry, I'm missing a zero there. $700,000, cash value of 19,454. Okay. And then when he turns 60, at age 60, we look at the cash value and the death benefit at that age. He's got over $500,000 in cash value, in total cash value right now. So $504,000 in total cash value. Let me put that in there. 504,123 in total cash value. And his death benefit has grown to $1.3 million. Okay. So 1300123. Okay. I just want to keep this real and use real numbers here so that it makes sense to everybody. All right. So your dividends are added to your account in the form of cash value, even though you still have liquidity and access and use and control of the money. How do you access the money? Through policy loans. You collateralize this cash value and take a loan out against this asset, against this cash account. It's almost like a CD loan, okay? Same kind of thing, or a line of credit. Make sense? All right. So by age 60, actually we were looking at 65, sorry, 20 years down the road. So it is right, 694,928. 694,928, and death benefit is 1491400. 1491400. Make sense? Okay. So we click next and save. Whoop. All right, what's going on? Sorry about that. Don't know what happened there. Let me get this calculator back up real quick. Go to the same thing that we were working on. Click next and save. Okay, now what this allows the client to do is to take all of their assets that they have in savings, meaning that 401k, and they can create their own personal pension program. If they took their 401k and spent it down at 3.5%, it would only generate about, $60,000. Okay. And with their cash value in their cash savings account, even if they spent it down at 3.5%, it would be gone in the first year. That's what this calculator is showing you. Okay. And so the net effect is they'd have less than 60,000, but let's just call it 60,000 in income. All right. If they were to create their own private pension program and put all of that money into a pension-like fund, 1713726, put all that money in there. Whoop, I guess it's 727. They would be able to spend that money down at a much higher rate because pensions are guaranteed income for life, and they generally range, I don't know if you can see this, anywhere between 7 and 13%. That's been the historical average payout for pension funds, okay? That would generate $171,000 a year, all right? Which is guaranteed for life. Now, these clients are accustomed to making about $150,000 a year at their job. So they're saving a significant portion of that money in their 401k and in cash savings. But think about this. Let's say you go home and you run into your significant other and you say, hey, honey, I've got good news and I've got better news. The good news is we retire. I get to retire next week. The better news is I get a pay raise. Wouldn't you feel more comfortable with that? Okay. And remember, that's guaranteed income for life. Guaranteed income for life. But you don't have to set up your own private pension program. You don't have to do that. Okay. You can always just spend that money down at a higher rate than 3.5% or 4%. Okay. I choose 8% because it's just slightly less than the pension program, but you can spend it down as much as you want to. You can spend it down much faster. The challenge becomes, how much volatility buffer do you have in the form of cash value in your life insurance policy? Because if you spend down that $1.7 million at 8%, yes, that'll generate a lot more net spendable income, but how much volatility will you be able to handle? Well, I like this because generally we shoot for about 5 years of volatility buffer, meaning volatility buffer just simply means that if the market goes down and you don't want to dip into this pool of cash, your 401k, to spend it for retirement, you don't have to do that. You can dip into your cash value in your life insurance policy tax-free and just use that money. And if you were to do that, you could do that for over 7 years before the market recovers and you can go back to your 401k for income. You follow me? And so let's click View Summary and Save. Here's the realistic numbers of this scenario. If you just use your existing 401k and savings account, you'll have about $33,000 to spend every year in retirement, which is a significant pay cut from what you're accustomed to living on now, that $150,000 a year income. That's a huge pay cut. So think about that, going home and saying, hey, good news is next week I get to retire. Bad news is that we have to take a huge pay cut. Okay. Now, if you continue to add to the pot, into your pot of cash, it will give you a little bit more money. But if you decide to create your own personal pension program that will guarantee you $171,000 a year for the rest of your life, that's $126,000 more than what your current plan is every year. So let's just calculate that right now. 126,406 times, and let's call it a 30-year retirement. Look at that. You've just found or created $3.8 million in spendable income guaranteed for life in retirement. All right. So do you have to build a $5 million nest egg to live comfortably in that scenario to get a pay increase at retirement? No, you don't. The point is you have options. And then, of course, the last option is a combination of the two. You can spend down your 401k money and your savings or your other assets faster and at a higher spend down rate and still increase your income, knowing that you have cash in your insurance account that you can dip into should the market collapse, or should you have to put that money back in cash on the sideline and you need another pool of cash to dip into for retirement income. All right. Again, that's a $92,000 a year increase from what we had before. So let's calculate that. 92,132 times a 30-year retirement. That's an additional $2.7 million in net spendable income at retirement that you didn't have, or that you just created by adding this weird, obscure asset class called life insurance. All right. So I hope that's helpful to everybody. That's it for today. Next week, we're not going to be having class because it's going to be Thanksgiving. Keep everybody in France in your thoughts and prayers, and have a wonderful Thanksgiving. And we will talk to you soon.